All right, hey. So, talking about airdrops today, I've spent a lot of time in this space over the last 6 months, particularly layer zero. Just a lot of kind of takeaways and things and nuances I've learned over the time, and kind of the idea is to kind of condense that into this presentation here and provide some resources for you guys to get started and whatnot. Now, this slideshow is going to be like really text heavy, but I made that on purpose because I kind of want to use this as like a resource for people to kind of refer to and read back through, and like it's kind of like a culmination of like my thoughts and other takeaways and stuff like that. So if it sounds like I'm reading a lot or it's all text heavy, like that's intentional as well. And then I will go through a bunch of different topics like, why airdrops, what to focus on, what not to focus on, how to be more efficient, things I'm focusing on and why. And then at the end, we're going to have kind of a Q&A session where, anyone can ask anything they want. Yeah, if you guys have any questions throughout, feel free to cut me off if you want, if it's pertinent. But ideally, we just kind of leave it all to the end so I can plow through all this information as well. And yeah, we'll get started. So I titled this kind of how to win, quote unquote, on airdrops, making the most use of your time and money. So first off, like why airdrops? What are the pros and cons? Because like everything, I think it's good to kind of weigh the risk and reward potentially as well. So when it was a lot easier kind of like 6 months ago or during like the last summer where like Gwei was consistently 5. It's kind of more of a bear market activity, but you can still do it now. It's just more difficult or might cost a bit more. So the gas is low. The attention to competition can be lower. The biggest pro, obviously, is it's arguably very good risk reward compared to the other ways to make money in crypto. Like you can potentially make like a 10 to 30x with very little capital investment. So the example with that would be Arbitrum, where you could have spent roughly like $30 from bridging and transaction fees because you only needed like 8 transactions and relatively easily hit the minimum allocation of like $600 roughly. It was around 600 arbs was the below point there. So this is obviously good for people who are time rich, quote unquote, but maybe capital poor as well. So it's good for people entering the space or who have lower portfolios. It's a good way to kind of boost out your portfolio as well. The other advantage is you can build out like what you could call a high quality wallet or a history of wallets across multiple chains, potentially qualifying for future airdrops. So the most pertinent example would be Celestia recently. So for the top 10 to 20% of wallet users on L2s before January this year were basically eligible, and their airdrop was worth $300 to $900 per wallet. And Celestia has actually gone up 3x since that airdrop, so it would actually be worth 3 times that much more now. And I do think that protocols are incentivized and maybe more likely to kind of target these high quality wallets in the future if they're looking to kind of onboard people as well, like maybe from Solana or something, right? They want, the top percentage of EVM wallets to, qualify and kind of incentivize activity and attention for their protocol. So the cons, obviously, the biggest con is it can be very time consuming, monotonous, and boring if you don't have the skills to create your own automation software. There are a lot of automation retail software tools out there. The best ones I've heard of are kind of Farmer Friends and Loopbot. And there's other ones like Copilot, and then ones that are just like scams, like Airdrop Fusion and a bunch of other stuff. The reason I personally don't use them is you basically have to trust third-party software, and you can't guarantee control of the private keys of the wallet, right? So, when layer zero happens, I expect a ton of people or these projects to quote unquote get hacked, and then just not distribute to their users basically because you're basically trusting that these third parties are, maintaining these keys safely and that they will actually distribute the airdrop like they say they will, even though, the incentives are skewed in their favor to not do that. So that's why I don't do that. But if you have the skills to create automation software, that's how you kind of win at scale, and we'll get more to that later. Obviously, money wasted on gas fees, slippage, inefficient routes. It's the highest level of delayed gratification in crypto, in my opinion. For most projects, it takes roughly 3 years before TGE, the token drop from generally the project's inception stage, like the first phases of testnet, the farming windows can last 6 to 12 months, usually 3 to 4 months of delays on roadmaps, like everything in crypto. And then the constant uncertainty of no guarantee of reward or that it was worth the time and money invested. And you could potentially, spend time and money, not hit thresholds, or not do it before the snapshot, and technically that time and money is wasted. The other downside is there's a lot of noise and info dilution from engagement farmer threaders or projects doing community tasks, so like pointless Galaxy NFT campaigns. So it's easy to get overwhelmed and distracted with all the projects, fighting for your attention for their drops. But the advantage of why projects will continue to airdrop, you know, it exits the. This is a post by CC2 who kind of summarizes it well. It's an exit to the community by giving ownership and inviting active participation in operating, growing the network. It's the quote unquote best way to decentralize and have a community owned network. Increases production capital, so a smaller percentage allocation for startups can result in overall money. Their slice can become more valuable. And then probably the biggest pro for them is it's one of the strongest organic marketing tools. So if people make money, they will be talking about it, and you'll have potentially loyal users, or they will stay on the platform. Raise equity is an option for the tokens. It aligns the founders and investors early on, and then kind of like the playbook for people for the airdrops is the project raises capital by VC. They have a plan to quote unquote decentralize the network, which is VC talk for token distribution. You reward you empower the community members with governance rights, which is another kind of fun verbiage around the terms, by giving them a stake in the network. And yeah, so basically airdrops are a tool to leverage community growth, create a network effect, and community ownership is critical to the success of project of a network. So a good example of that was like Say, the engagement farmed people a really long time, and it was worth like peanuts at the end of the day, and everyone was calling it Say scam, and were really bitter and annoyed. And then stuff like Celestia was kind of like the exact opposite, where they just kind of rewarded high quality DeFi users and other users online. And people were pretty happy with that, especially since it gained a lot of mind share and attention from influencers, so it 3x'd after that. How to pick what to farm, right? These are kind of questions I ask myself on how to decide what's worth my time, because you have to kind of be very selective because there's just so much L2s and other things to focus on these days. So, does the product offer something innovative or unique to the market, right? If it's just another fork, like obviously it's not worth your time or interesting at all. Another key point is like how much money was raised, what is the FDV and valuation placed upon the project by VCs. So ideally, you kind of want to see like at least 5 million raised. Ideally, 20 to 25 million plus raised. Will the market value this project around the FDV from VCs? And what is kind of the FDV of the closest comparables of this product? They've given indications, but no confirmation of the airdrop, i.e., having a point system, need to decentralize the network, enrich reward, empower the community. The more they actually deny the existence of the airdrop, the more bullish that actually is to a certain extent. It's kind of a sliding scale. If they're extremely aggressive in advertising it, it's generally pretty bearish. If they basically deny it completely, but there are slight indications where they're hinting at it, that's actually a lot more bullish. And there'll be less competition around that as well. Another key consideration is how much time and money is it going to take me to get in the top 20% of wallets compared to other opportunities. So generally the threshold is the top 22% and higher of all wallets. So that's basically your goal, is to be within that threshold. How many other wallets am I competing with? What is the average quality of these wallets? So we'll go over like what thresholds and quality means. So generally, because there's only a certain amount of metrics you can measure a wallet by. So X amount of transactions, volume, unique contracts, stuff like that. Are other people, credible people in the niche, putting their time and money into this project, basically? What is their conviction level and what they are farming, basically? and then basically valuing the airdrop. So generally the airdrop value is basically the FDV plus the total supply, like not necessarily plus, but as well, the total supply percentage allocated towards the airdrop. So basically the higher the FDV or the supply given towards the airdrop, the more valuable it is. You'll never know really the supply percentage of the airdrop until release. You could speculate it on it if they have like a section called like other or community. Ideally, it's at least 6 to 11% of the supply, though. So for context, the most lucrative airdrop, which was Arbitrum in the last year and a half, was roughly 2 billion FDV with 11% of the supply dropped, if I have that correctly. I used to think it was total supply plus total tokens, but it's not actually the total amount of tokens, because if the FDV or the valuation of the project is the same and you have 10 times the amount of tokens, those tokens are still worth the same amount. You just have 10 times the amount of them, right? So it's actually like the FDV plus the total supply percentage roughly given towards the airdrop. So how to decide what to fade? The product doesn't hardly work or function. So the example would be like SWE or the Shardium testnet. In my experience, I tried just interacting with it. It was so horrendously non-functional. I instantly faded it, and it was clearly a good choice. Overly aggressive engagement farms to milk network activity, attention, and capital from NFT events. Do all these tasks, mint this NFT, pay us $2 to mint this NFT. We're gonna make 100K from all these NFT sales, and then they just keep doing that. Example there was, say, like I said earlier, preemptively advertising an airdrop early on and continuously advertising it to attract and retain users. So like, it's not necessarily bad if a project kind of brings focus to it or kind of uses that to incentivize it. You're more so kind of looking for overly aggressive marketing tactics and overly high focus on the airdrop and how great it's going to be and all that type of thing. The funding or the FDV is too low to comparable projects within the niche. It's too time or capital intensive. So, example, you need to like LP or provide liquidity for like 10K plus for several months in order to compete and qualify with whales. That money could be much better spent on other airdrops, or lacking transparency from the team, or a higher risk of smart contract exploits. Generally, from what I've seen from other people and myself, it's I tend to avoid almost all money lending markets for airdrop reasons, just because it's much more complicated smart contract wise, and that's much more likely to get exploited than just like your average DEX. The only example of like what a safe money lending market is like Aave, basically, because they have that like Lindy effect and they've been around for so long. That would be like the only one I would trust. All right, so where am I focusing my time? Layer 0, obviously. The window for that's kind of closing. I think like in the next 2 to 4 weeks, the snapshot's gonna get pretty close and sketchy for that, but we'll go over that in a bit. So why layer 0? Basically, it's a more novel way, or a different way to kind of bridge tokens and NFTs. 125 mil funding with 3 billion valuation. It seems diluted because there's 3.6 million wallets around there, but most of them are actually low quality. I've spent most of the time in the last 6 months positioning for that. In terms of low quality wallets, we'll go over how to see that using Dune dashboards in a bit. And Layer 0 is taking its time. Lots of stuff has been delayed. The original TGE on the investor docs was for Q4 this year, but basically the consensus is that it's going to be Q1 next year. Could be as early as January. People are hoping and thinking it will be as early as January. Generally, the snapshot is 30 to 50 or 60 days before the announcement date. So like if they announce the airdrop in February, the snapshot could have been taken late or the beginning of a month or a month and a half before that. So you got to keep that in mind. So you kind of need to like bake that in to your whether you want to decide to do something or not. So scroll, it's just another ZK rollup L2. Vitalik endorsed and mentioned. which isn't a big deal, but like it adds, some credibility to it. They've also been building for a while, like over 2 years. 83 million funding with 1.8 bill valuation, relatively low wallet competition. I would say based on the Dune dashboards. The gas fees are kind of a bit expensive. It's like 80 plus cents and 30 Gwei. So, but stuff that has slightly higher gas fees, by like 50, 70 cents per transaction, there's arguably an edge there because less people are concentrated on it. The ZK Sync, the quote unquote leading ZKL2 rollup, in terms of attention and mind share, 450 mil funding. I didn't add the valuation, but it's in the billions. Hinted at tokens, it's going to be pretty obvious they're dropping a token. The problem is that it's kind of like the most obvious farm, so there's a lot of higher dilution and competition just because of the attention mindshare it has on Twitter and other things like that. There was a case where someone, tried to Sybil 21,000 wallets, and they actually made their own DEX and deployed it on ZK Sync and were doing trades on that with all their wallets, and that's how they got caught. So clearly, a newer Sybil, because I don't know why you would make your own DEX and be the only person to interact with it. But that's just an example to show the scale people are going to, farm this. So Starknet, the network is very painful to use. It is, pretty slow. The gas fees are pretty bad. They're like, over $1.30 Gwei. But the funding is large, 100. It's another ZK rollup L2 rollup. 100 mil, 8 bill valuation. Basically, the consensus from like GitHub docs and other people is the airdrop's expected to be in this January. Could be delayed though as well. Manta, so another L2, 25 mil funding, 500 mil valuation, recently launched. Again, like similar to Scroll, low wallet competition under the radar. I would say it's pretty good risk reward for periodic interaction. What does that mean? Roughly 4 to 6 transactions every 2 to 4 weeks, basically. Like you basically just want to, do a couple 4 transactions a month, get that unique month on there. And yeah, Linea, which is by consensus, the creators of MetaMask and Truffle, they have 7 mil funding. Gas fees are expensive, but they do horrendous engagement farming campaigns, and it's very irritating. If you're trying to debate whether I should do it or not, I would say, always do it on like one wallet if you want to do it, just to avoid potential cope if it's actually worth something down the line. That's kind of how I think about that. Base chain chief legal officer stated in the interview it's not out of question, but they need to have regulatory clarity, so it's unclear, when or if this will happen. The bull case is basically it would be a very strong onboarding and user acquisition tool for Coinbase when crypto has a bullish cycle for all of their retail users and other users. Base chain is basically just based off the optimism stack. So that's kind of the sentiment there. Some others are not really high priority as like optimism. They might do a part 2. You're kind of doing optimism passively while doing other stuff. Aptos has hinted they'll do another airdrop. Manta as well. Brentech as well. I've made a underfarmed airdrops Twitter list as well that you can click and follow. So in terms of all these, what should you do in order? In my opinion, if you're starting out, there is still potentially time for layer 0. I would say, 2 to 4 weeks before it starts to get sketchy. So I think it's still worth your time to do that. And you can, qualify relatively easily if you just use Merkley refuel feature and use a lot of destination and source chains and do the gas refuel feature. And I'll go over that later. Following after that, I would say either Scroll or Manta are pretty close together. Maybe Starknet, like start the footprint, just because the airdrop is expected this January, so the snapshot might occur in December if it's in January. So, if you're not sure, like, should I start it or whatever, it's good to, at least get a footprint. And then generally, thresholds for like minimum, is like 1 unique month, 8 transactions, at least $1,000 in volume. But you could do like lower, right? That's just kind of like based off ARB and other things. That's kind of like minimum thresholds for that. And then after that, probably ZK, then Linea, and then Base. If I were to order those in terms of priority, just to give you guys some ideas there. And these are kind of like alternate airdrops. So if you feel overwhelmed with all the airdrops, like don't worry, that's normal. Basically, you'll find a way to slowly pick at the ones you find are relevant over time. And we're also going to be looking at ways how to stack multiple airdrops as well. So there's the perp dexes, there's Hyperliquid, Ambient, Azuro, which is a sports betting platform, and Arc Digital. Out of those, I would focus on Hyperliquid and Ambient. Hyperliquid seems to have a pretty good team and product. Heard a lot of good things about it. I've used it myself. And they're doing a point system now, which means an airdrop basically. Like it's soft confirmed, and they're retroactively applying points to people before that. Ambient, a lot of people feel there's going to be an airdrop as well, and they just launched on Scroll, so that's how you can kind of get Scroll transactions while also qualifying for Ambient. So it's an example of the 2-for-1. So bridges, aggregators, bridge aggregators and bridges. So Li-Fi Jumper, Bungie, which are aggregators for bridges, Orbiter, Layer Swap, dBridge, and VIA Router, which are other bridges. These are things that you're not necessarily farming alone, but things you will farm as you're moving money around to other places while you're doing other things. And then dexes, so like use during your routes or instead of using Uniswap. So basically, like let's say you need to switch stables because you need USDT to bridge from this chain to just chain instead of USDC. Instead of just going to Uniswap, you should be trying to use dexless or tokenless protocols or dexes like Bebop and Odos because they're tokenless and they do the same thing as Uniswap anyway. Just stuff like that, right? And you slowly kind of build out this list over time. Like basically the way I kind of recommend people do it is, you create a bunch of bookmark folders categorized, and then you add all the projects into those bookmark folders. And then you don't have to like remember or try to find it later. You're just like, hey, instead of Uniswap, what's that DEX that I need to use? And then you go into the bookmark folder and you're like, oh, okay, yeah, I need to use Odos this month or whatever, right? Sync Swap, which is on ZK Sync, Linea, and Scroll. And then the other ones are kind of Slingshot and Gamma Swap. And I kind of listed those in order I would do them. There's other ones called what I call like LP and wait. So you just provide liquidity, and that's basically the main interaction. So Spice Finance, which is kind of an NFT-fi platform, you basically put it into their Blur Vault, and then they make money off of borrowing and lending as well. I don't have a ton of exposure as well, but I do think NFT-fi is interesting, and SpiceFi seems like a decent product. So just put in a bit of ETH to that vault, and just let it. These are things you want to let sit for like 6+ months, right? So you don't want to put in a lot. So it's like capital you're not gonna feel like you're missing, and you just let that sit and then wait. Eigenlayer is the big one. I don't remember all the technicals behind it. It's complementary to Ethereum. A lot of whales and people are bullish on it. Again, it's just you basically deposit LSDs or liquid staking derivatives of ETH, so like Rocket Pool ETH, Lido ETH, stuff like that. You just deposit the ETH and wait. Swell is kind of similar. You basically put in ETH, you mint their version of ETH, which is a liquid derivative of ETH, and you get pearls for that. And then you can actually LP that onto other platforms like Maverick. Maverick had a pretty good season 1 airdrop. They have a season 2 as well. And they're also on Base and ZK Sync. So you can get interactions there while you LP on there if you want to do that. For NFTs, the easiest one is Zora. That's 6 mil funding, 600 mil valuation. Basically, you just bridge onto the Zora chain, which is an L2, and mint like 1 to 2 NFTs a month. I think if you bridge more than 0.018, you're above like a vast majority of the wallets. So if you bridge that much, that 0.018 ETH, you'll be above most of the wallets. The other one's like mint.fun. So you mint NFTs for free or cheap, and they have a point system on there. That's basically just an alternative to just using Zora. So you can you can use mint.fund to mint NFTs on Zora, so you're farming both at the same time. They're also on Base. I would recommend also using the Zora official site as well, if you're doing Zora. Um, so Polyhedra as well. Basically, they created a certain type of NFT standard. They have 25 mil funding, and you can bridge a ZK NFT on their site or Merkley as well, which gives you a layer 0 interaction as well on that. This is a lot here, but this is basically Solana projects. So the main ones are kind of Drift Protocol, Jito Margin, Fi, Camino. Many of these projects will overlap with each other. For example, you mint Jito Sol using Jito and then deposit into Camino or MarginFi. I'm not going to read through all this, but you'll have reference to this, and I referenced the person who talked about it who basically sums this up very well. But basically, these are kind of the best projects to spend your time in on Sol. And then he's basically going through ways that you can, stack protocols essentially. I do think, after Celestia, which rewarded users, and then the recent Jupiter airdrop announcement, I think there will be more money from ETH or EVM chains and other people kind of moving their capital to Sol to take advantage of those airdrops, because I think the momentum has started. And maybe that's explained some of the price action as well. And Tensor was another good one that happened recently. They're doing future airdrops, but the very first one was pretty good. You basically got roughly, if you put in 5K volume, it's basically blur for Sol is what Tensor is. If you put in like 5K volume, you basically made 5K worth of their token and NFT. So yeah, I do think capital will move to Sol over time, especially when something like layer 0 drops or gas gets really high or the bull market gets really aggressive and the gas on EVM chains and ETH mainnet get really high, because that makes everything on all the L2s significantly more expensive potentially. So, people will, once layer 0 happens, there's gonna, the timeline's gonna be flooded of FOMO and engagement farming like there was with ARB. So I'm not even going to do anything EVM related for like 2 months, to be honest, probably, if that happens, because it will just be so over congested. And yeah, usually the wallets spike, and then about 2 months later, they just slowly go down over time because people lose conviction and interest. So that would be a good time to maybe rotate to Sol, or you want to front run that now. So that's kind of my thoughts on that. Just some summaries: the ROIs, indexes, and bridges type of drops are usually much lower. Just the amount you get is usually typically lower. Like with Connext, what's the recent one, and Clipper before that. Unless you kind of push the top 20% of transactions or volumes. So it might not be worth your time for those less time and energy and capital compared to like the L2 chains that I said before. And you should be kind of integrating these into your routes rather than just trying to aggressively farm these outright, which kind of gives you a passive farming effect. But it could also be worth relative to the time and investment if they are lesser known than chain airdrops. So the example is Tensor, like I just said earlier. And Tensor was kind of the one that's kind of started the Solana bullish sentiment of airdrops on there. So I know this looks like a lot of info, but this is basically the idea of combining airdrops whenever possible. So, as you kind of build out your knowledge and bookmarks of these dApps over time, you kind of see ways that multiple things overlap with each other. So the example, Jumper, which is the bridge, a bridge aggregator, if you pick the Stargate option with that, your Stargate uses the layer 0 contracts, so you're qualifying potentially for Jumper's 25 mil in funding. I think there's a decent chance they'll drop a token. But if you pick the Stargate route, you're qualifying for layer 0 and Jumper. With Bungie, it's another aggregator, same thing. Polyhedra, kind of the same thing I mentioned earlier. So Polyhedra, decent chance at a drop. If you can use their website to do the ZK bridging, or you can use Merkley, which uses 0. So you're getting your layer 0 interaction and your Polyhedra interaction. Using the Aptos bridge, which is there's a certain bridge by the layer 0 team for bridging to and from Aptos. So Aptos has still a large allocation for community or future drops, so there's reasonable speculation that they will drop more in the future. A lot of these projects too are also waiting for more bullish market sentiment because if they can launch with the kind of a lower circulating supply, there's a lot more potential for the token to go up quicker and easier. Sync swap's another big one. Just swap tokens, LP there to qualify. It's also on Linea and Scroll and ZK. It has the most TVL out of all of ZK Sync. So if you were to LP on anywhere for ZK or Linea, probably do it on Sync Swap. So there's a decent chance for token there. Avenue.fi, so it's like a DEX on StarkNet. Use that. Akubo, basically, it's just to provide liquidity, and the token's been confirmed because Uniswap submitted a proposal that they are going to offer a certain amount of their tokens in order for a certain amount of the Akubo tokens. There was like a government's or foam poster proposal put forward, so that's why that's confirmed. So it's like instead of just like swapping randomly on StarkNet dexes, if you swap with Avenue, Akubo uses Avenue as its swap. You ideally want to concentrate your swaps on something like this, or if you're going to LP, you should probably do it on Akubo because they have a guaranteed token compared to like another DEX. That's basically kind of the point of this. Ambient Finance, kind of mentioned that earlier, and they're also on Scroll. MarginFi, kind of mentioned that earlier. You provide the Jito Sol, borrow against it. Both platforms at the same time. MAV, we mentioned that earlier. MAV protocol, provide liquidity, do some swaps on it. Azuro, Azuro is a bit complicated. I probably wouldn't recommend it for most people. It's like a sports betting platform, but you can provide liquidity on there, on Linea as well. So potentially qualify for Linea and Azuro. And yeah, I think you get the point. At the bottom, use cost-efficient aggregators such as DeFi Llama, Bebop, Odos, qualify if they go the airdrop route, which I mentioned earlier. All right, so how to craft a route, right? So there's only a finite amount of on-chain metrics you can use to evaluate or filter out potential high-quality users. So generally X amount bridged. Usually I recommend use the official bridge at least once, even though it might not be necessary, but sometimes, the project criteria is sketchy. For Arbitrum, it was pretty weird. I know some people who you shouldn't have to use the official bridge, but some people who did or didn't qualified and vice versa. So there's a whole issue with ARB. I think they kind of misallocated the criteria for a lot of people, and I've written about it as well. But basically, if you can use the official bridge at least once, the problem with that is it's almost always bridging from ETH mainnet, so you kind of need to wait for GUI to be low. Ideally 20 or less. Generally, GUI is the lowest evening times EST, and especially Friday, Saturday, and Sunday evening. So just a note there for that. And then for the rest, I just use a third-party bridge. So Orbiter, Layer Swap, RhinoFi. Orbiter and Layer are also tokenless. OmniBTC, Owl2 is another one. And just bridge from like a cheap L1 like Binance or Polygon, or an L2 like Arbitrum or Optimism. Yeah, or you could refuel with Murky if you want the layer 0 interaction. It's not as efficient though. And then basically you're going to use Dune dashboards to see what ranges X% of wallets bridged in, and you try to want to be above 50%, ideally 80% of wallets. You're just trying to get an idea of what kind of the average or low quality amount of people are bridging in. Basically, like if 60% of people are bridging, 0.015 or less, you might want to bridge 0.02 or more. That's kind of the idea there. The amount of volume, use tokenless dexes to push volume, or bridges in layer 0's case because it's not really a chain. You can provide liquidity as an optional higher criteria interaction, somewhere to park your funds. You want to wait before pushing more volume. And then those are all examples of places or dexes to push volume. And then like we mentioned before, LP and volume indexes that don't have a token yet, and you don't think will get rugged and exploited. So kind of why I mentioned sync swap. They have, like with everything with LPing, there's always smart contract risk, which is why I avoid money lending markets, and generally go with the stuff that's been around the longest and has the most TVL. It's generally the safest, right? There's risk in everything. You can't really avoid it completely, unfortunately. And then some other threshold metrics would be like X amount of transactions, unique contracts, unique months and weeks you've interacted with. And then there's kind of like the more optional niche tasks, like the buy and sell NFTs for respective chains. So Element and Zonic have stuff for like ZK, Lightning and Scroll, Mint.fun and Zora we mentioned. There's the Mint domain names. That's kind of, I would only do that if it was cheap, like $5 or less, that's not really necessary. Maybe only do it on some wallets. Find methods to boost transaction count using an interaction with the cheapest gas fees possible. So email seems to be really popular for this. So it's basically a Web3 email service where you can basically send yourself an email, and then it uses a transaction on chain, and it's generally very cheap. You can also deploy and call your own custom contracts. Or use tools like Merkle, ThirdWeb, and OmniSea to deploy your own contracts. Merkle seems to be the easiest. ThirdWeb, you need to make an account now, so it's kind of annoying and hard to scale now for that. And then some projects in the past, like Optimism, have rewarded ETH mainnet users. So this is why I kind of recommend people start with their older wallets that they've used in the past for NFTs and etc. Because there's kind of like a higher quality organic on-chain history with those wallets typically. And hopefully the cluster size for those wallets is under 20. We'll go over that in a bit, but a cluster is basically any interaction you've had between wallets, whether you sent any type of token, ETH, or NFT between wallets. And if the total size of all the wallets that have interacted are under 20, generally that's the safe threshold based on past filter criteria. So this is kind of me taking an example from the Dune dashboard using threshold metrics. So, we can see 3.2 million users or unique wallets for layer 0, which seems very diluted, right? But, when we look into it a bit deeper, 81% of them have interacted with less than 13 contracts, which isn't a ton. And then, you can see what it takes to be in the top 5, 10, 15%. This may be a bit outdated by like a month or two though. And then same with like destination chains, which is chains you've bridged to using layer 0. Again, most are under 11. It may seem like a lot, but it's actually very easy to get a lot of destination chains using something like the Merkle refuel feature. And then just going into this more, like 80% are under 32 transactions. So every time you use a bridge refuel or do any type of interaction that uses a layer 0 contract, that's a transaction. The active months, most, if you're around 4 or higher, you're in the top kind of echelon there. If you're worried like, oh, I'm starting too late, layer 0's too late, you might not hit the unique month criteria in terms of bonus like points for that, but you can easily make that up for that in other ways, like all these other threshold metrics. The bridged volume, so yeah, just it's pretty self-explanatory. And then source chains, which is where you're bridging from. So this doesn't give you a good idea of like what the low quality wallets are, but like there's like 50% of wallets that are like 2 source chains, 3 destination chains, like 5 total transactions, and like under $1,000 of volume, right? So like relatively when you put it like that, the competition is considerably lower. Oh yeah, here we go. So 34% less than 5 transactions, 27% with 1 source chain, 37 with 2. Like, and 1 source chain is like literally nothing. Like so yeah, and I'm just trying to. The colors are not in order, so it's kind of throwing me off a bit. The amount bridged rate, so 28% less than $100, right? Let's trying to look here. So yeah, if you bridge like more than $1,000, you're over like 35% of the people, right? And then destination chains kind of the same thing. Like 35% have only bridged to 2 different chains. And then same thing with all the other metrics, active days. And in terms of the past, it's usually unique months that matter, not unique days or weeks historically. So just keep that in mind. So how do you find the relevant dApps, right? How do you know what to interact with? How do you become less reliant on influencers? So generally, you can find the top rate projects on DeFi Llama. Check the ecosystem page, and then you can check the resources from the official project's Twitter, website, and Medium. Generally, the project will have some sort of an ecosystem page on their official site or somewhere deeper, and then you can see what dApps or other people or threaders are using or recommending. I'm just gonna grab water here. So how much do I farm? We kind of went over this. Use relevant Dune dashboards to get an overview of the competing wallet metrics, bridge volume, total transaction volume, etc., average wallet balance. The other thing is you want to leave a bit of money left on the wallet before you rotate funds out. Arbitrum gave a -1 point to wallets that had less than 0.005 ETH on it. So generally, $15 on the wallet should be enough. Just a note there. Basically, you just don't want to use all the funds and then leave like, $1 or less on it. That's like pretty obvious Sybil activity. Do what you need to do in the top 20, 10%. Do it when Gwei's low. Use a spreadsheet to keep track of your interactions. Make your own guide or sell it for cheap or distribute it for free to build social credibility, which is kind of what I'm doing because it saves a lot of time and effort trying to be like, what have I interacted with what wallets and when? And stop reading the same threads with the same content from multiple people and start farming. So here's an example route. This is kind of more comprehensive and, might seem a little messy. So try to summarize it here. It's generally pretty, if you kind of categorize it, it's straightforward, and I'll kind of do that here. So basically you need to get gas, right? Obviously on the chain. You can use Jumper, Bungie, or Woo, which is a cross-chain deck, and then toggle the gas refuel option. So for something like layer 0, I would get gas on what I call the core 5, which is Binance Smart Chain, Polygon, Optimism, Arbitrum, and AVAX. The reason I call them the core 5 is they have the best liquidity and the least amount of slippage between each other for most of the dApps you use. So generally that's like a good starting point. So, I'll get like however much capital you're starting with on a wallet and then bridge like $7 right away to all of the other chains. So I'll have, how much on Optimism, and then I'll bridge $7 of the gas token to all of the other 4 chains. That way you have gas on those chains already ready to go. And this will save you a lot of time doing interactions down the road as well, instead of you having to switch into the gas token and then switching out to stables, etc. It'll save a lot of time that way. Yeah, I don't know if I should read through all this because of how helpful that will be. But I'll go through it quick, I guess. So basically, you're funding the wallet. You do a cross-chain swap using a DEX to a different chain. That's a unique source chain or unique destination chain, unique contract because you're interacting with Woo. This next one is what I would call an ERC20 interaction. So you're buying an ERC20 token and using the bridge feature on layer 0 to bridge back and forth. So in this case, the 2 main ERC20s I recommend doing is the Bitcoin .be, the Bitcoin bridge, because that bridge is created by layer 0 themselves. And then the other one would be Angle with their Euro stablecoin, because the slippage is pretty good on that. So realize my recording is cutting off the top there. So yeah, basically you have your Bitcoin bridge. do a rotation through all your chains, and then so you bridge the. You have to kind of buy out on AVAX or Arbitrum because the slippage is better there. You'll find kind of that stuff out later as you kind of do it. DeFi Lemma is just like a DEX aggregator, so it's just a nice tool to use to save time and find out if you can actually swap in and out of it or not. So for like the Bitcoin bridge example, you bridge from AVAX to OP to Binance Smart Chain. You might want to bridge to ARB and then Polygon and then back to AVAX, or maybe you just want to sell it into stable coins at that point. Ideally, you kind of want like 1 to 3 bridges there. And then use Merkley to mint and bridge a NFT. Use Stargate to bridge. In terms of, a lot of people are kind of saying like, do I need to stake Stargate? Vote on the governance proposals, because that was a bonus criteria for ARB or for optimism. I used to think it was more important, but after kind of counterpoints and reading opinions, I don't think it's that important. In terms of layer 0, I think what the most important thing is having unique source and destination chains, because that kind of enforces the main thesis and deliverabilities that layer 0 wants to provide. You're also providing more fees to layer 0. Next would probably be the amount of transactions you do. Next would probably be volume. And then next would probably be, consistency and unique contracts. And then stuff like stake Stargate and vote on it. The reason people think this is because Stargate works very closely with layer 0. But Stargate is not layer 0. So providing liquidity and, staking Stargate and voting on the proposal, isn't as high a priority as I used to think. But yeah, in that order I said earlier, is kind of the priority, I think, for layer 0 interactions. Yeah, and then, so what is all this? How do you make a route? I basically kind of like section it off into what are the different types of interactions I can do. What is, I want to hit, in this example, we use Woo, Mugen, Stargate as our cross-chain DEX transfers. We use Bitcoin as our ERC20. We use Merkley to get our NFT interaction. And then the other ones use Liquid Swap by Aptos. Layer 0's also made their own Aptos bridge. So people, soft recommend to use that. Liquid Swap is also tokenless, so you can, bridge in using Liquid Swap, do a swap on there, and then bridge out using their official Aptos bridge. So you're hitting, the Aptos, and it's by officially layer 0, but this is kind of how I organize it into thoughts. This is kind of like bonus if you just want to splice that into the route. I've kind of written 2 threads on that. But it's, it's basically, I want to hit kind of 2 to 3 different dexes, cross-chain dexes, 1 to 2 different ERC20s, at least 1 omni-chain NFT interaction, because it's probably going to be a multiplier and it's very quick and easy to do. Stargate is kind of optional. You want to use their bridge, but a lot of the cross-chain bridges use Stargate anyway. They're just routing through Stargate. And then the Aptos is kind of like a nice optional bonus if you want to do that, because it's basically like, what's the best kind of optional bonus that's worth my time? Well, layer 0, officially endorses the Bitcoin and the Aptos, so that might be worth my time. But it's not necessary, right? You could technically do this for less and cheaper by just going for source destination chains using Merkley and then pushing some volume. Like if you want to do like bare minimum, that's like the way to go. And I'm actually experimenting this on some wallets. Like I'm doing a section of wallets that are like quote unquote high quality with a lot of this stuff, and some of them that are literally just refuel feature on Merkley, get the source destination chains, get some volume, and get an omni-chain NFT, and we'll see how that plays out. But the idea, in my opinion, there's a lot more upside to having more medium to low quality wallets than trying to have 1 to 2 of the highest quality wallets, because the difference between the highest and the mid to low is not as much as if you just did more mid to low, basically, if that makes sense. And it's kind of a dick measuring contest with the Dune dashboards, like, oh, I'm top 10K of all wallets, blah, 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 right? And like, that's great if you need to, assert social authority, you have Twitter, you want clout or whatever. But historically, I don't think that's the way to go because it's also a bad way to hedge your risk. Like if that wallet, gets mistakenly filtered out or, wrongly allocated a lot lower than it's supposed to, then you're screwed, right? But if you have like, 5, 10 medium low wallets, in different clusters and other places, you're hedging your risk a lot better that way. All right. So we're almost done here. So how to multi-account and not get marked as a Sybil, right? This is one of the most common questions and topics I get asked and people wonder about. So what is a cluster? I mentioned that earlier. Any transactions that have occurred between wallets you've controlled. Historically, probably safe. Cluster size under 20, which has been used for Aptos, ARB, and Optimism. Extra safe, under 7, or under 8, really. So the most aggressive filtering ever used was for Paraswap, which was too aggressive and people were angry and their token did terrible. And then Moonbirds as well, which people just ironically bought it anyway through pre-mint anyway. So basically, like, if you're under 20, you should quote unquote be safe, historically speaking. If you want to be extra safe, keep it to under 7 if you're spinning up new clusters. Basically, like, how do you move? Basically, sexes or centralized exchanges are used to move and recycle funds to different or new clusters without connecting the clusters together. So it is very important that you use a sex with a sub account feature. This basically allows you to create a unique, basically lets you create more deposit addresses, so you can have unique deposit addresses for each wallet you are sending money to, right? Because if you have the same deposit address and you're sending all your money from all the wallets from different clusters to the same deposit address, you're connecting them, right? But if you have different deposit addresses, they're distinctly separate on chain, and it just goes into your exchange account, right? It's the same exchange account. So withdrawing from the same exchange account is fine because it's just going to come from their hot wallet on chain, right? Usually it's publicly labeled like KuCoin 7, Binance Hot Wallet 6, stuff like that, right? So withdrawing is fine. It's the depositing where the deposit address needs to be unique. And again, using a spreadsheet for this type of thing so you don't accidentally, mix and send things to the wrong thing or keep track of where you've sent what. Are you trying to appear like an organic user on chain? All of your actions should be based around the thought of, is this something a real or organic user would do? So things they would not do, things an organic user would not do. Fund and withdraw from the same wallets. So basically, from Nansen and other filter criteria, they basically run algorithms to analyze the wallet that funded all the wallets and where the funds came in and the wallet where the funds came out. And then they're basically looking for overlaps on there. So where the funds originally came from and where they're going is very important. Are you using the same route and sequence of all the interactions between wallets, right? Are you doing the exact same route between the exact same chains around the exact same time with the exact same amount of volume, right? You ideally don't want to do that. You want to make it, as random as possible, basically. Same amount of volume. All the transactions are low volume transactions, sub $1 to $2. This is more so for bridging. So kind of the exception for this is layer 0 because you are capped on how much you can bridge for it. So if you're using the refuel feature and you're only bridging like less than a cent or 10 cents, which is the case for a lot of these, that's fine because you're capped kind of a lot of the time and you're just trying to get quote unquote like the initial gas token on that chain. It's more so like, is all of your main volume between bridges like sub $1? Are you spamming, like 50 transactions a day, that type of thing? The wallet's in low time frames. So are all your interactions in the wallet occurring in a very low time frame? Arbitrum gave a -1 point criteria if all the transactions on the wallet happened within 48 hours. So that's kind of a threshold there. I would say like 2 to 7 days is kind of like what you don't want to do. You don't want to do all of your interactions within a short time frame. You're also not really incentivized to do so, right? Because you want to have unique months and days as well. So like airdrop is a very long, methodical, do it in chunks type of activity. It's not like I got to do it all this week and then never touch it again kind of thing, right? And then for something like layer 0, don't bridge to a chain and then immediately just bridge back to the same chain you bridged from, Ideally, you've integrated something where you bridge to the chain, you do some sort of interaction that you need to do anyway on that chain, and then you bridge to a different chain, right? You just don't want to bridge to a chain and then within, the 5 minutes bridge immediately back. Sometimes that's fine. If you're bridging volume like with WolvesDao, which is kind of the meta for building volume on layer 0 because there's basically no slippage. The only thing you can do is bridge in and out, right? But they used to only support Binance BSC chain, but now they support like AVAX, Polyarbin, Arbin OP. So instead of just going BSC to core to BSC, you should probably be like BSC to core to optimism, optimism to core to Arbitrum, that type of thing, right? So IP addresses and proxy browsers. So historically, few projects of the past have tracked IP addresses of wallets, and there isn't really a reason to believe they'll do so in the future. But some like Aptos have in the past, like if you had 20 plus wallets with the same IP when connecting to their site. If you're using MetaMask, go into your settings, security and privacy, and toggle the batch account balance request to off. The consensus around this is having this on makes it so like Infura, which is the default RPC for MetaMask, isn't batching your wallets information and IP addresses together. And it's not like MetaMask is going to like send your IPs to these protocols you're interacting with. But maybe for something like Linea, they could, right? Because they own Linea, right? But it's just something you don't need to have on. The next step is to use a customer privacy-based RPC opposed to like the default you're given. An RPC is basically what your wallet uses to communicate and interact with the blockchain on the back end. Having your own basically, yeah, I mentioned that earlier. The more information is more likely to be aggregated. Most common privacy RPC that people use is like BlockPi, Anchor, and OneRPC. They're also free to use completely, so there isn't really an excuse. You just, you need an email, you sign it up, you like, hey, I want an RPC for this chain. You basically just copy the URL into like one of your settings, the network settings, and you just paste it in. You're good to go, right? VPN. So IMO, you should kind of have a VPN in general for crypto, as it allows you to occasionally switch between connections to obscure your actual IP for a particular wallet or cluster. People in the space seem to like Proton VPN or Molvad. I use Proton. I haven't used Molvad, but I've heard good things. You basically just want one that is reputable and doesn't log and save your information. So if you want to use a different one, that's fine. Just make sure they don't. I would avoid Nord personally. Express seems alright. I used to use Express. Nord just seems like too like quote unquote normie and chilled on YouTube and stuff, and their policies around logging user data isn't clear to me, so that's why I don't use that. So proxies. So the final level after this is to buy proxies and use a privacy browser. So basically, this allows you to have a unique IP footprint tied to a specific wallet to make that IP address for that wallet as unique as possible. So basically, to get an understanding of how deep this meta goes, bigger, more serious Sybil whales in the space will buy data center and residential proxies for each wallet. And they'll actually have complete automation software custom done, and they'll be hiring third-party labor in cheap countries and have entire offices of people working for them, monitoring them as well so they don't, steal the wallets or whatever. But they're basically farming. They basically build out an entire industrial-sized operation to farm at scale with people and automation. So that's how deep this meta goes. Example, with Arbitrum, there was a ton of Chinese farmers, a ton of traffic came from China when the airdrop happened, and people made millions of dollars just hitting the minimum allocation on hundreds or thousands of wallets. So it's kind of how deep this goes. The privacy browser allows you to create multiple profiles similar to a Chrome and Brave profile, and then each profile basically has an IP attached to it. Popular privacy browsers, Dolphin Anti, Octo browser. There's one other one I can't remember that people use. People use proxies because many VPN connections could be marked or recognized as a VPN. So an example would be for like social media accounts. If you try to make a new Twitter, Facebook, or GitHub account because you're trying to like build out the GitHub passport, which is, they argue is a Sybil filter tool, but it's not, in my opinion. If you use a VPN and you make one of these new accounts, your account will basically immediately be disabled and blocked. But if you use something like a proxy, you have to use something like a proxy to do that if you want to get around that. In general, I do think there's kind of an overemphasis placed on IP and proxies. There isn't really a right answer, but if you want to be more cautious, you have more capital at risk, you're running a pool funding operation, you want to be as risk averse as possible, then those type of people will probably use proxies, but can start to get expensive at scale, usually around $2 to $3 per proxy every 30 days. So, as you get to 10, 30, 50 wallets, it can obviously get pretty expensive, 100 wallets. So in my opinion, I feel like a VPN will serve the purpose for most people, but it may not always be the best option depending on your situation. Do you have a question? Okay, guess not. So IMO, the only time IP tracing is at risk is if you're using the front end of an official project's website. So if you're using the official ZK sync bridge or Line A bridge, it's gonna be the only time they're actually gonna potentially be recording what the IP address that's interacting with their site. So for something like layer 0, it's not even applicable because you're not interacting with the layer 0 site, right? You're interacting with multiple different dApps that are just using the layer 0 contract. All right, almost done. Things I wish I did earlier. Learning how to be more efficient. I mentioned this earlier, create bookmark folders. Include all the relevant dApps and links that you'll be using repetitively. It keeps you organized and saves you time. And you don't have to remember which dApps support which chains. Log and track your progress using a spreadsheet. Saves you time. You don't have to remember what you've done. Several days and weeks can pass between interactions, and you're not going to remember what you've done. And then if you do, and then you have to come through the transaction history, which just takes time. Use the Dune Analytics dashboards and other similar tools to give you alpha on the wallets you're competing with this particular dApp or ecosystem. So it can tell you what wallet thresholds you need to hit, be within the top 20 to 5% of wallets. Gives you a sense of how competitive or underrated a certain chain would be. Example being Manta. I think it's only 50 days old and only has 18.2K unique wallets. It's around that's a bit outdated because of the Dune dashboard. It's around 80K now. But, compared to the 5 million on ZK Sync and the 3.6 million on layer 0, significantly lower, right? And for 25 mil funding and 500 mil evaluation, it's pretty good risk reward to get a footprint on there, in my opinion. This is gonna be my Rabby wallet shill. So objectively, I think it's a better wallet than MetaMask. People don't really believe me till they start trying it. I have no incentive to promote Rabby to you, but it's just better because it lets you see the balance on all your chain. It lets you see the gas balance and token balance on all of the chains you have balances on simultaneously right within the window, right? So why does this save you time? You don't have to dig through every network while on MetaMask to remember, hey, did I have stables on ARB or was it OP or was it Polygon? Do I have enough gas here or this here? You will waste so much time filtering through networks, figuring out where your positions are and where the gas is compared to Rabby where it just gives it all to you right away. It also shows you your LP positions as well. If you're LP'd in a certain protocol, most of the time it shows up in Rabby. If not, people submit proposals and it usually gets updated pretty quick. So you don't have to, forget, hey, I put this much money in ambient, and you forget which wallet it is. You might want to pay with a recording on which wallet you put it in, but it will show you, oh, I put this much in ambient on this chain, and it will show it right away. The other big thing is that Rabby switches the network in the background when interacting with the dApp UI, which saves you a lot of time. It doesn't sound like it will save you a lot of time, but if you're like, hey, I'm bridging from this to this, and then when you click it, it will automatically switch the network for you in the background, so you don't have to go up to the network, find it, select it, right? It just saves a lot of time, especially with something like layer 0 where you're constantly changing chains, and Rabby supports 90 chains or something, so it's going to have probably the chain you need. And it also gives you other little features like revoke and exploit warnings if there's certain contract addresses that are exploited. It's also made by the DBank team, which made DBank, which is a really good just DeFi tool in general that people use. They have 25 mil in funding. And using their swap feature could help as a bonus criteria for that airdrop. Have some sort of plan and pace yourself. It's a marathon, not a sprint. Most people give up in the first 2 months. The uncertainty of rewards and being too aggressive with farming burns all of their liquid and fees. Example, post Arbitrum FOMO, like I mentioned before. Start with your wallets that you already have an organic history on. Find ways or routes to hit your wallet metric thresholds as cheap as possible without spamming all the interactions within a week. Learn from others. Don't follow people that use clickbait or photoshopping images saying, you know, airdrop guaranteed, confirmed, and then, they're photoshopping the picture in the hook. Examples of accounts that I hate that do this are No Brain and Arzador. And I'm pretty sure they run a syndicate of, 10 to 15 plus alts of people who just post similar or the same content. And they've run multiple scams as well. So yeah, just accounts to avoid. Kind of good counts to follow, I guess, would be me. CC2 Ventures is a good one. Wrong User is a good one. T-Nut is a good one. Olympio is a good one. Mingo Airdrop is a good one. Fast Life, Xerox Fast Life is a good one. And there's like one or two other good ones. There's, not a lot. And you'll kind of know over time. You'll kind of see that filter, right? Is this person actually adding substance? Or, is this person doing a super engagement baity hook and then just telling me to like do some swaps on these decks as I already know about, type of thing. And all of the threads will look the same after a while. So, eventually you'll just learn to mute and block these people, and eventually you get filtered to kind of the better people. Find accounts that provide, so kind of segueing, I guess, to what I just said, find accounts that provide insight have been right historically. You have to also double check they aren't LARPing. So, having proof of non-LARP is nice to have, where they post some sort of public wallet that they can prove. You could also use their public wallet and study their transaction history via DBank to see what they are doing, what are they LPing, what are they interacting with, how much, when. That's what I did for CC2. Yeah, he posted his public DBank, and I went through his entire transaction history, and this basically gave me insight into apps I didn't know about before he made threads about them publicly, and what he was spending his time on and why. Obviously, this is probably more time-consuming for people who don't have the time or don't want to do that, but that's just potentially a way to gain an edge. This also led me to create the resource sheet that I use for myself, and that I'm giving to the public to keep track of my progress. You can also use Dune dashboards to find wallets of people who have succeeded in past airdrops in the past to see what they are doing. So there's like certain Dune dashboards, like people who have hit whales or other people who have hit all of the past airdrops. So that's potentially wallets you might want to look up on DBank and see what they're getting involved in. That's it. So open Q&A, I guess. You can type in the voice chat here. I posted this slideshow in the chat there. I'll go through kind of the guide as well. So, yeah, thanks. So this is kind of the free guide I made for people. It seems like a lot, but this is just kind of breaking it down. This stuff is all the, and then I kind of made like a quote unquote paid guide for like $30 just because I think people will value it more if they have to pay a little bit of money. Obviously, we're giving it to the Wolves for free because we like the Wolves. And yeah, the goal isn't really to make money. The goal is like, hey, here's a resource. Hopefully it helps you build social credibility for myself. Hopefully you make a bunch of money. Maybe you tip me in the future and I recycle that into more content and more airdrops. So yeah, I'll post this as well. You can just request access to it and I'll grant access for you for that. And then just going over it quickly. This is basically everything I've already talked about. This used to be more alpha like 6 months ago, right? This is just me kind of explaining different things. This is me kind of breaking down all the dApps on what they do and kind of why they're important. Multi-accounting. This is kind of where you put your tracking what your wallet is. There's a Dune dashboard where you can put in your wallet address and it gives you different metrics for what you have. It doesn't track all the chains. So if you don't, you don't have certain source or destination chains or transaction amounts as high as you think it is, it might be because it doesn't track certain changes. And then this is kind of like how I keep track, right? So you don't have to do everything on this list. This is just for you to keep track, right? So, did I use Stargate? How much money did I go through? How much liquidity did I provide? Did I use Woo Finance? How much volume swaps did I do? These are basically the cross-chain dexes. Scroll down for me. Your kind of ERC20 interactions that I mentioned. Your Aptos bridge interaction. Your NFT interaction. There's multiple different tools you can use. Merkley is the best one. Unique source and destination chains for Merkley if you want to keep track of that. This is more so, this is optional. This is like, hey, I want to keep track of what I've added and removed. You can, you can make a copy of this. You can edit this how you want, add rows, remove rows. You can edit these as well, right? So if you want to change the values or the colors of whatever these cells are, you can do that. You can hit done, and then it will apply to all of the cell of that type. So it's basically editable however much you want. This isn't necessary. This is like, hey, I'm splicing in ZK at some point in my layer 0 interactions to have a footprint there, if you want to do that. And then these are kind of more niche ERC20 interactions. So be careful with the more niche ones, because like stuff like Joe, if you do like $500 at once with Joe, you might lose like $8 to slippage, right? So you want to check that stuff, and it's probably not worth the time and effort to do that. It's just kind of extra. There's a ton of like niche ERC20 interactions you could do, but I don't think that's really applicable to a lot of people. Stuff like Radiant, you can buy, borrow, cross chain with that. I added all of the CC2, alpha niche threads. This is just kind of stuff to get you informed. That's optional as well. Some of the Dune dashboards, and yeah, I think that's my right. So the minimum I try to have for each wallet, that should be volume. Stargate volume, 2 different cross-chain dexes, so like Woo and Omni. The ERC20 is optional, but if you were to pick it, it'd be Bitcoin and Angle. 2 to 4 cross-chain NFTs. You can use Merkley. I would do at least one Merkley one and then one ZK NFT, because that interacts with Polyhedra. Bridge to Aptos and back if you want. Yeah, and that's the priority for that. We'll go over Merkley quickly. Merkley's kind of a cheat code because of how easy it is to get source and destination chains using Merkley. Instead of using the Omni fungible token bridge, which you basically mint a useless token called Merk and then bridge the token, I would use the gas feature because it kind of looks more organic if you're using it as a way to get gas on different chains. They basically just pick where you're bridging from, where you're bridging to, and then that's it, right? And you're basically trying to find combinations of cheap interactions between wallets. So I put a picture of this in the airdrop thread here in the WolvesDao. I'll probably add this in the slideshow as well. But like, over time you'll figure out like what chains are cheap, right? So just going through here, Meter's cheap, Cilo's cheap. You already have gas on AVAX. That's cheap. Not cheap. That's cheap. Moonbeam's cheap. Moonriver's cheap. XDAI's cheap. Kava's cheap. Polygon's obviously cheap. You're already gonna have gas on Arbitrum. Base can be cheap.
Insightful. Can you just explain what is the gas refuel versus just like a bridge?
Yeah, so basically you're just a bridge would be like, hey, I'm moving stable coins from this chain to this chain, or ETH, or a different tool. The gas refuel is just, I am bridging $1 of optimism for $1 of the gas token on the chain I am bridging to, basically.
Gotcha. So it's a swap and bridge together to give you gas on that other chain.
Yeah, it's basically a way to get gas on the other chain. And the reason, I recommend Merkley is because it's pretty hard to get to have a layer zero interaction that goes to all of these different chains. Like there isn't dApps that let you get to Loot or Tomo or OPBNB or Astar or Conflux or Aura like at all, right? So you can use the refuel feature on Merkley to hit these pretty easily, and they're pretty cheap, and that gets your destination chain count out. Um, and then same thing with the source chain. It's sometimes even harder with the source chain because you need gas on the chain first and then bridge from there. So, and then there's like little tricks like that. Like, you can bridge, like, you want to find ones where you only have to bridge to it like once, and then you can bridge from it one time. So, like, instead of having to do multiple refuels because you're capped sometimes on what you can do. So, the example would be like DFK. You can bridge, you need about at least 7 cents of DFK gas to bridge from DFK to another chain, and you can bridge like 30 cents or more to DFK. So like you can, bridge to Optimism to DFK, and then from DFK to the next one. So that gets you your source chain. Other ones is like Moonbeam. You can bridge from Polygon to Moonbeam. You need at least 0.6 of that gas, and that's another source chain. And then you can bridge from like Moonbeam to Harmony, and then bridge from Harmony. So that's another source chain. Yeah, I might put some like routes or whatever, guides or whatever, but kind of what I do is, I'll have gas on the core 5 anyway, and then from Optimism, you can go to Loot, Astar, that Conflux and Tomo for cheap. That's 4 destination chains there. And, switch it up from like Arbitrum, or from Arbitrum to EFK, it's another destination chain, or sorry, 4 destination chains. And then Arbitrum DFK is a destination chain, and then bridging from DFK to whatever else, that's a source chain. And then whatever you're bridging to is another destination chain. Yeah, no, you're good, Ice Frost. But yeah, that's basically it. That's basically all my thoughts dumped out. I'd also, if you're doing Manta, I talked with the ZK Hold'em team recently. They reached out to me to make content on them. All I can say is that they are funded by Manta. They are an official ecosystem dApp of Manta, and they have a point system. So that means they're probably going to airdrop. And the wallet competition is very low. And there isn't a lot to do on Manta. So if you're going to do something on Manta, you could do this. The problem is, it's basically like Texas Hold'em, but on chain. The problem is there's no like lobby search feature, so you have to like share a room code and get at least 2 total people to work together. Or in theory, you could share it with one of your alts, and do that. But yeah, they're like the number 2 or 3 dApp on Manta right now. So, and the wallet competition's pretty low, and they're running a points campaign for like the next 4 weeks. So, with like 6 hands, you can rank for that. So that's some alpha, I guess, and something I'm going to do and focus on. Yeah, any questions? Anyone feel free to chime in or type in the chat. I know that was really long. But that, it's kind of that was intentional. It's just like an encyclopedia of info that you can pick from kind of over time. Yeah, that's kind of the idea.
I have a question. So basically, after having spoken to wrong user for a bit, I realized that he essentially uses a different seed for pretty much all of his wallets. And I think I asked you this before, but what are your thoughts on, I guess, using a bunch of addresses on the same seed that are not necessarily clusters?
Yeah, did he give a reason for why he uses a different seed on all the wallets?
I don't think. I think in general, I just get the vibe from him that he just tries to be as careful as possible. So I think that's just what it is.
Yeah, I think he uses proxies too. To me, that seems extremely excessive and difficult to manage. Like, I don't want to write 50 seed phrases. Um, you know, I think you asked this, theoretically, unless they have the seed phrase, they don't know what wallets can be generated by that seed phrase unless you're sending transactions between those wallets, right? Like, that's my
I
understanding.
think the only
It's
other way would be via the batch batch balance call in the MetaMask wallet, right?
Right. Or
Unless you're connecting the wallets, like that's the whole point of like it's not you can't like the way blockchain works. Like the private keys are derived from the seed, but you can't go backwards. The same way public key is derived from the private key, unless you actually connect them together. Like I'm not a dev, but like I have like 98% certainty because I've looked this up before that that's how it works. Is that like unless you literally have some kind of way connecting them, or you leave your seed like on your computer and your computer gets compromised because it's like a hot wallet or something like that, there is no way to connect them.
Yeah, exactly. That was my understanding as well. So I think he's just being excessively cautious potentially. I think a unique seed per wallet is pretty overkill. Yeah, because I think like Lem said, it's like literally impossible for them to connect that unless you're connecting them on chain or, there's a seed compromise and they're not gonna, put in random seeds to see if they're connected that way. Basically, the filtering is done by like where is the wallet funded from, where's the funds going to, and then how similar are the transactions between all the wallets in terms of time, amount and what the interactions are doing. That's basically the filter criteria. And the filter criteria is it's like a balancing game, right? They don't want to be too aggressive to, filter real users and piss people off. They're more concerned really about finding the most egregious symbols, right? Which is kind of why they go with the 20 or more rule. They want to find the wallets with like 50, 100, 1,000. That's kind of their main priority and concern. And like to be honest, if you get filtered out, they don't care, right? Like Arbitrum did not care. I saw a ton of people who basically got misallocated a bunch. Like they don't care if a few thousand people got misallocated, whatever, right? They have funding or launching the token. They did the simple, the filter criteria is generally pretty vague, but it's like, hey, we use this algorithm and these metrics around these thresholds to kind of filter it out, but you never know exactly how it's done, right? We just have to use past drops and try to use historical data as best we can, really. So, yeah.
Yeah, it makes sense. And I guess I can, if no one else is asking a question, I'll ask another one, which is in terms of like your routines, right? Because for me, what I've done so far over the last, I don't know, 4 or 5 months, for most chains, I maybe have like 1 or 2 routine max, but I generally interact with like very similar protocols. Like I guess how much do you actually think about how many different or what protocols each wallet is interacting with? Um, or I guess, do you care more about just interacting with them at different times with different volumes versus, um, I guess not interacting on the same protocols?
Yeah, so I'm definitely more so the exact same time and volume. I know what you're saying. You're like, if I only use sync swap and one other thing, am I gonna get filtered or whatever? Like, in my opinion, not really. Like, especially if it's a top DApp or a highly used contract address. Like, ironically, so there was like a good argument case that like Merkley is basically like a honeypot for farmers because you quote unquote bridge useless tokens, which is kind of why I recommend the gas feature. But like the counter argument to that is like layer zero wants people to bridge to different chains. Merkley actually enables that. And yeah, their refuel contracts are actually one of like it within the top 20 contracts on Optimism and Polygon. Um, so, if it's highly used, it's probably not gonna seem like, unreasonable to use that, you know? But yeah, I agree. Like for me, it's like, hey, there's kind of like 1 to 2 main dApps I use or whatever, and then I try to find like 1 to 3 other ones and just try to interact with them once or twice just to have that unique contract address on the history, basically. That's kind of how I think about it. Does that make sense?
Yeah, it does. Thanks.
Cool. Anyone have any other questions? Feel free to jump in. It's your time to ask whatever you want.
How much time do you spend focused on this? Like, I think realistically, there's 20 of us, and we're definitely not all going to go into the same depth that you do. I know you outlined a couple that you would focus on, which is very helpful. And I think, what I'm planning to do is start to try to copy a route and just, see how it goes and then expand from there. But what kind of time would you expect and kind of capital outlay would you suggest starting with? I know capital is obviously different for everyone. But yeah, what do you see as being sustainable and like easy to get started with?
Yeah. So again, that's relative. Yeah, it's a question of like how much time you have. Like the reason I went in so deep for this was basically like there's hardly anything going on in the market the last 6 months, and I thought this was the best risk reward for my time to figure this stuff out and kind of go deeper into it. Stuff like ZK, Scroll, Linea, all those L2s, like they're easily 8 plus 16 months away. I think easily. So you got lots of time for that. The only one that's probably time sensitive would be like Layer 0 and Starknet. It also takes a lot longer when you first start, especially if you're not DeFi native, because you're not kind of familiar with the dApps or how they work, or where's the button, why isn't my balance showing up, that type of thing. So as you kind of interact with these more over time, it does get easier and quicker. You kind of find little efficiencies, stuff like that. In terms of how much money, I would say just don't use like a very low amount. What is a very low amount? I don't know. Like you don't want. It depends. If you're trying to hit the volume threshold, you want to kind of compare what are most people doing for volume, and I kind of want to be above that if you want to do that. Volume isn't always everything, but it's generally a decent factor. Psychological thresholds, are like 100, 250, 500. It's a good intro sound. 250, 500, 1,000, that type of thing. And, the thing is like, the more volume that you're putting or capital you're concentrating to a wallet, that, those funds are, kind of a liquid for other things, whether that's farming or other things you want to do with it, especially if you're LPing. But I like in theory you could just have like a few $100s and be fine. Like just trying to think about Arbitrum and Optimism. Yeah, like before way back in the day, I bridged like $120 to Optimism, did one swap on Uniswap and qualified for like $1,000, right? And it's more like you could put more volume, but you just won't hit the volume threshold points kind of for that metric. It's more so, how many transactions do you have, unique over time, stuff like that. So like I would say in theory you could do it probably with a pretty low amount of capital, like a few $100 in theory. Technically, you just don't want it to be like a bunch of sub $20 or $2 transactions as your only source of volume, because that's probably not going to qualify you. Ideally, again, I would say like over $1,000 is like a nice psychological threshold for a lot of things, but it could be a lot less depending on the competition. Like stuff for like Manta and Scroll, you would need a lot less because people aren't focused there and the gas fees are a bit higher. So there's not a lot of competition there compared to something like ZK. Does that kind of answer the question? That makes sense.
Yeah. And what about the time spend?
Right. So that depends on kind of scale you want to spend. I think everyone in this call here could easily casually do 3 wallets. or like any of this stuff, right? It's more so like really like you don't have to spend a lot of time at all. Like you could like on a Sunday you could slot like 1 hour, you know, and do the hard part is kind of getting the funds on all the chains, to be honest, and like getting comfortable with the dApps. That's what takes longer. But like once you kind of have funds on there and you have money on the dApps, in theory it takes like 5 minutes to do like 4 swaps on whatever, right? So if it's like on a Sunday and gas is low, you're like, okay, I'm gonna do, like 5 interactions on scroll, 5 on ZK, and 5 on another chain for 2 wallets, right? And that shouldn't take you more than an hour, really, right? And then you only do that like once every 2 weeks, right? It depends how you want to do it. At the same time, you could be like, I want to manually do 50 wallets and spend, an hour every day to try and do that. So it depends. It depends, right? Because the more time you're investing, the more time you're potentially throwing away if you focus on something that doesn't come to fruition. But if you kind of focus on, the stuff that you have higher confidence will happen and you kind of hedge your risk by, not spending too much time, I think you don't have to spend as much time as it may seem like once you kind of get started. It's more so about putting in time consistently over a long period, to be honest. Does that make sense?
Yeah, fair enough.
Another tip I received regarding, because like the volume question, I don't know if you'd subscribe to this as well, Insightful. Basically, what other more experienced farmers told me is essentially if you have $1,000 that you want to deploy into farming, rather than putting $100 on 10 wallets or even $200 on 5 wallets, put $500 or split it in half and put it in 2 wallets. Focus on volume for 2 weeks, and then you should have like specific deposit addresses anyway, and maybe you have them on 2 dexes. So you kind of just farm volume, go into maintenance mode on those wallets, and then you rotate that capital to other wallets.
Yeah, 100%. That's what you should do. That's what I do as well. Basically, a lot of people like to front run the volume up front as well. I end up doing it kind of near the end for whatever reason, just because I usually want to hit all the like decent criteria or whatever. But yeah, absolutely. You definitely want to concentrate the volume to a lot less wallets, than a lot more wallets, because it's not only going to take you a lot longer to hit the volume threshold, you're also going to be paying a lot more in fees as well. So yeah, if you have like $1,000, just concentrate that to 1 wallet or 2 wallets. Do whatever volume threshold you want to hit. Rotate that to the next wallets in the cluster. Usually, I keep the clusters to like 5 or 7 if I'm doing new clusters, just because it's easier to manage. And then when you want to recycle it, leave a bit of money behind. Obviously, set it to the SACS deposit address and recycle it basically. But yeah, that's definitely the way to go because it's a lot quicker and saves you time. And people like to put the volume up front sometimes because they just want that done. But basically the goal is to get the wallet in maintenance mode, which basically means you've hit all the kind of the thresholds you want to kind of hit for the wallet. And then you just interact with the wallet like once a month, basically to get that unique month trigger on it. Sometimes people do it twice a month, but yeah, once you hit the wallet in maintenance mode, you're golden. All right, any more questions? Before we wrap this up. Recording is an hour and a half, so.
I think just to leave people with the main takeaway to get started, just if you talked about choose, a few active wallets that you already have, concentrate some funds there and try to get it started instead of splitting it up over multiple. And then of your multiple resources here, your full guide, your full guide resources, your Twitter, where would you suggest they go to start a route? Is it within the doc that you just presented and like go to that route and try it out?
Yeah, so you don't necessarily have to follow a route. It's just like you basically need gas on whatever chain wherever you're going, and then it's like, you know, find like 2 to 3 dApps you want to interact with, and then just start a history, basically. Ideally, you want to just get like 5 transactions on the wallet, because usually a lot of the low-level symbols only have 1 to 2 transactions, especially like on the early chains like Scroll and Manta, and then 4 is like kind of a threshold. That's why I say like 5. Well, yeah, technically a nonce of 5 is 6 transactions, but yeah, I would just say get the gas on kind of the chains, or where you want, or layer 0 is not really a chain, but just get kind of the funds there, get the footprint started, and then just do a couple interactions on the dApps. And then, you know, kind of like with the bookmark thing, as you kind of add all these dApps to your bookmarks, you just kind of go into the bookmarks. Okay, like I want to do this and this today, or, you know, you interact with the same 2 to 3 dApps. Yeah, and then just get started that way. I think that was a good summary, the way you put it. Does that make sense? Does that answer the question?
No, totally. And I can see, you know, your bookmarks up there.
Yeah.
So
Yeah. Oh God.
what would that? Yeah, how does that kind of look for you when you're clicking through?
Is it,
It's like you bridge to dap to dap to dap, kind of all on the same chain in the route.
I guess we can go through it,
You don't have
right?
to share if you don't want to. I think
Yeah.
just an overview. You don't have to go detailed. Just to like how it's structured.
Yeah. So in terms of what dApps interact with, that's what I kind of use the sheet for. Like, okay, I've already interacted with Woo and Stargate. You know, maybe I want to interact with Omni BTC now because I haven't done that. And then maybe the Bitcoin bridge because I haven't done that yet. That's kind of the idea there. Like the layer 0 one is just a nightmare, right? I
Okay, you
don't.
know what? I can't see the drop down. I think as you're sharing the
Oh,
screen,
right.
but it doesn't want to share the bookmark. That's all right.
Okay, yeah. But basically, yeah, the bookmarks are just kind of just to remember what the dApps are to find it. But like with the sheet I made, that's kind of the point as well. It's like, hey, I have all the relevant dApps I need right there. And then you just kind of pick at them over time. You don't have to do everything, but you know, ideally you want to try to do like 1 transaction on each different one to get that unique contract if you want it. I'm trying to think. For Arbitrum, the thresholds was like 8 transactions or unique contracts. I don't remember, but yeah.
Awesome, insightful. This was amazing. Thanks very much. And I speak for everyone here who's been captivated. It's very useful.
Yeah, appreciate it. Yeah, it should be helpful. Yeah, and if you guys have any questions, just post them in the airdrop chatter. DM me on Twitter. And yeah, hopefully you just kind of need to get started and just plug at it over time. Yeah, it's a long game. It's, you know, I do think though with relatively low effort and capital, if you're kind of like concentrated and you put in a bit of time over a long period, you know, you could do really well. The thing is people are pretty impatient, and it is kind of, you know, grueling sometimes waiting. But yeah, I agree. So here's kind of the criteria for ARB, just to give you an idea. That doesn't mean it's gonna follow this. It's just kind of an idea. So you give points for 4 and 10 different contracts, and then also 25 or 100. Yeah. And again, that's why I say like more medium to low quality wallets, because you would have had to hit the gap between 25 and 100 for 1 extra point is a lot less than getting 3 points on more wallets for 4 to 25. That type of thing. But yeah. No one has any questions. I think we'll close it off. We'll wait a full 10 seconds of silence. If I don't hear anything, I'll cut it off. But yeah, thanks for coming out and spending your time and listening to me rant for an hour. Hope you found this insightful. All right, cool. I think that's it for the questions, so I'll end the recording there.